There are so many myths and misconceptions when it comes to investing on the stock market, and today we're going to bust 3 of those most common myths. How's it going, guys? Ryan here, and today we're busting 3 of the most common myths when it comes to investing on the stock market. And these are some of the reasons why a lot of people are a lot more hesitant to get involved with investing. And I want to really just target these 3 in particular and disprove these myths once and for all. But before we get into that, guys, please remember to like this video. It helps me out so much, and subscribe to keep up to date with all the latest content I'm uploading every Monday and Thursday at the moment. And if you want to leave any comments, questions or queries down below, let me know, and let me know some of the biggest myths that you've encountered on the stock market since you've been on there. So without further ado, guys, let's get straight into the video. So 3 of the most common myths regarding investing in the stock market. And the first one is you can time your entry on the stock market. This is one of the silliest myths that I've heard, and it stops so many people from getting into investing. Often you'll always hear about bull markets, bear markets, those sort of things, and there's the best time to get into the market. And while that's true, it is impossible to predict when the best time is to get involved in the stock market. You don't want to be looking at the market as an overall entity. What you want to be looking at is the individual companies that you're looking to invest in. You can be in a bear market and still have lots of fantastic companies which are growing with their share prices increasing. And you can be in a bull market and you can have lots of companies dropping in value significantly. When it comes to actually timing the best time to enter the stock market, the timing really comes down to what is your ability to get into it. At the end of the day, that is all it is. You don't need to be focused on, oh, we're in a bear market at the moment, so I shouldn't invest in something because the stock price is going to go down because of that. Not going to be the case. And even if you have found something that you want to invest in, but you're waiting for the price to drop a few pips, that might mean you miss out on an opportunity. You can't time the market, you can't predict it, so don't try and do that. You're only going to end up missing either opportunities or money, unfortunately. So don't try and time the stock market. It is not something that I would recommend doing ever, not something I do myself. And I have tried to do it in the past, and it just, quite frankly, does not work. I've seen stocks which I think are absolutely terrible go up in value like incredibly quickly, and I've seen fantastic stocks plummet. And it doesn't matter what market you're in, bull market, bear market, or even if the market's moving sideways, it comes down to the individual company, guys. That's all it comes down to. Don't try and time the market at all. The second myth is sell your stocks when the market is dropping. This is an absolutely horrendous idea. Unless you're in something extremely risky, this is something you just really should not do. At the end of the day, if you look at the stock market long term, it is trending upwards. It's always been trending upwards when you look at a very long term perspective. Basically, what this means is as long as you've invested in companies where you know they are going to increase over time and they've got genuine value associated with them, don't sell the stocks, because what's going to happen is you're going to invest in a stock, the market's going to drop, and that means your stock is going to go down in value. What people tend to do then is panic, which drives the market down even further. Lots of panic ensues, and then effectively your stock price has dropped, let's say 10, 20, 30%, and you start panicking as well. You sell your stocks, and then in the coming weeks, it's recovered. And effectively, you've just lost 30% of your money or whatever value it is for absolutely no reason at all. So selling your stocks in a downturn in the market isn't necessarily a good thing. If you can manage to pick the top, good on you. But as we just said previously in the other myth, don't try and time the market. focus on the value of the companies that you're investing in. Focus on their future potential versus where they're currently sitting at. If they're overvalued, absolutely sell them, especially if you made a profit. Remember, taking profits is always a very, very good thing to do. Now, moving on to the third myth, and that comes down to diversification is the best way to reduce risk. And yes, while diversification is a good way to reduce risk, you can over diversify. So for instance, if you hold stocks in every single major sector, your portfolio is probably not really going to do anything. Yes, you've reduced your risk, but you've effectively diluted your portfolio, which means it's not the best way to reduce your risk because you've basically made it so that you're not making really any money at all, unless you're investing in something such as the Dow or an overall sort of ASX 200 ETF sort of situation. Then there's absolutely no point doing this. You're going to over dilute yourself, overstretch yourself, whilst yes, potentially reducing your risk, you're not going to actually make any decent gains at all. Instead, what I tend to do myself is I'll focus on one sector and one generic type industry. So for me, as you guys would know from my previous videos, I really enjoy mining stocks. That's what I know, that's what I understand, so I stick to the mining industry. My diversification then comes in where I'm picking different stocks. So for instance, I might be in a gold stock, I might be in copper stocks, I might be in iron ore stocks. That is how I effectively diversify and reduce my risk. Spreading yourself too thinly across lots and lots of different sectors is not going to help you out in the long run, or even potentially in the short term at all. You're not going to see much of a fluctuation up, but you're also not going to see much of a fluctuation down. You're not going to see much movement at all, guys, and it does limit your ability to specifically target those shares which do add genuine value to your portfolio. So what I tend to do, as I mentioned, is focus on that one sector and then invest across different companies within that sector itself. That is, in my opinion, one of the best ways to diversify yourself. So if you combine these three myths and actually look at why people don't invest, these are three key reasons why people don't invest. They just don't think the timing's right. They don't have enough money to diversify their portfolio, so they're at a high level of risk, for instance. And often you'll see horror stories of people selling their stocks when the market is in a downturn and effectively losing lots of money. It's really interesting to see people when they get started in the stock market, and I've been there myself, and you look at your stocks and you see them drop 5-10% and you have an absolute freak out. And I'm talking long-term stocks, and it's only a small daily change, but you got to look at the bigger picture when it comes to investing. So with that, guys, I hope you did enjoy the video, and if you did, please remember to leave a like. It helps me out so much, and subscribe for more videos such as these. And as I mentioned at the start of the video, guys, leave down below what your favorite sort of myths or fallacies are about the stock market that you hear people talking about, and why are these myths wrong? Because this is such a big issue when it comes to getting people invested or wanting to learn about investing in the stock market. These myths which are preventing people from taking that next step to elevate themselves. So with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.